Cash dividend. A cash dividend is the most common type of dividend that companies pay to their shareholders. Instead of receiving more shares, investors receive money directly, usually through a bank account or brokerage account. Public companies often pay cash dividends every quarter, although some choose monthly, semi-annual, or annual schedules. The amount depends on how many shares an investor owns and the dividend declared by the company's board of directors. For many long-term investors, cash dividends provide a steady source of income while allowing them to keep ownership of their shares.
Stock dividend. A stock dividend rewards shareholders with additional shares instead of cash. If a company declares a 5% stock dividend, an investor who owns 100 shares would receive 5 extra shares. The overall value of the investment usually remains about the same because the share price adjusts after the new shares are issued. Companies often choose this option when they want to reward investors while keeping more cash available to support future growth or expansion. Special dividend. A special dividend is a one-time payment made outside a company's regular dividend schedule. It often happens when a business earns unusually high profits, sells a major asset, or accumulates more cash than it needs. Since these payments are not expected to happen regularly, investors generally see them as bonus rewards rather than dependable income. Some of the largest special dividends in history have come after major corporate mergers or exceptionally profitable years. Preferred dividend. Preferred dividends are paid to owners of preferred stock rather than common stock. These payments are usually fixed, meaning shareholders know how much they are expected to receive before investing. One important feature is that preferred shareholders are typically paid before common shareholders receive any dividends. Because of this added priority and stability, preferred stock is often considered a middle ground between traditional stocks and bonds. Interim dividend. An interim dividend is distributed before a company's financial year has officially ended. Instead of waiting until annual results are completed, the board of directors may decide to share part of the company's earnings during the year. Interim dividends are more common in countries where companies report financial performance several times a year. They allow shareholders to receive returns sooner while reflecting the company's ongoing profitability. Final dividend. A final dividend is announced after the company completes its financial year and confirms its annual results. Unlike an interim dividend, this payment usually requires approval from shareholders during the company's annual meeting. Because it is based on the full year's financial performance, the final dividend often represents the company's complete decision on how much profit will be returned to investors for that year. Property dividend. A property dividend is paid using assets instead of cash or additional shares. These assets might include shares of another company, physical property, or other valuable holdings owned by the business. Property dividends are relatively uncommon because transferring non-cash assets can be more complex than making a simple cash payment. Even so, they can occur when a company wants to distribute value without reducing its cash reserves. Scrip Dividend. A scrip dividend gives shareholders the option to receive a promise of future payment rather than immediate cash. In some cases, investors may also choose to receive additional shares instead. Companies often use scrip dividends during periods when they want to conserve cash while still recognizing their shareholders. This approach offers flexibility for both the business and its investors during uncertain financial conditions. Liquidating dividend. A liquidating dividend is paid when a company returns part of its capital to shareholders, usually because it is closing operations or selling off significant portions of the business. Unlike regular dividends, which are normally paid from profits, liquidating dividends come from the company's assets. Investors often receive these payments during the final stages of a company's existence, making them very different from the dividends paid by healthy, growing businesses. Monthly dividend. A monthly dividend is simply a cash dividend paid every month instead of every quarter or year. These are commonly offered by certain real estate investment trusts, income-focused funds, and a smaller number of public companies. Many retirees and income investors prefer monthly dividends because they provide a more consistent stream of cash that can better match everyday living expenses. Although less common than quarterly dividends, they have become increasingly popular among investors seeking regular income.
Like and subscribe for more simple finance explainers. Turn on the bell so you never miss a new video. See you next time.